Welcome to GRE. I'm your host, Keith Weinhold. All the baby boomers are about to sell off their homes and downsize, unleashing a glut of supply onto the market, and housing prices crash. Is there cogency to that theory or not? I give you a definitive answer: the Trump bump. Then later, a pernicious vice is destroying more people's lives today, especially young men. And almost no one is talking about this. It's leading to lower credit scores, more bankruptcies, and even more suicides. Today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Hyannis, Massachusetts to Hiram, Utah, and across 188 nations worldwide. I'm Keith Weinhold, and you are inside Get Rich Education, episode 541. Just another slack-jawed and snaggle-toothed podcaster here. Now, a popular, I suppose, media narrative that's been out there for a long time is this premise that U.S. housing prices are going to crash hard because all the aging baby boomers are going to sell their homes, and boomers are the biggest generation in all of American history. This is just going to magnify the price collapse. It means far more home sellers than buyers, so soon enough, sellers will have to keep cutting prices. Everyone's going to undercut everybody to compete with all of these for-sale homes, so as a result, everybody's property values are going to collapse. Today, let's look at how bad it will get should you get ahead of this and sell it all now. And then I'll even tell you when this popular narrative will supposedly happen with boomers selling en masse, or won't it happen at all? That's what we're looking at. The term silver tsunami, you've probably heard that thrown around. In the real estate world, it actually refers to pent-up housing stock that older homeowners will eventually choose to sell, which would have that effect of flooding the market with all this new inventory. All right, now let's define what we're talking about here. Baby boomers are the generation born just after World War II, between 1946 and 64. That makes them between the ages of 61 and 79 this year. Okay, so basically these people are in their 60s and 70s. That's their age. My parents are baby boomers. President Trump is at the upper age limit for a boomer, but they're not all as old as you think. I mean, the youngest baby boomers include Michelle Obama, Sandra Bullock, and Rob Lowe. So not all boomers are like super old, but see, it is a big generation of over 76 million people. So whatever they do really moves the economy. And maybe you've heard it been said, my gosh, what if we have more dyers than buyers? But now a more nascent trend is that you hear about more and more boomers and people older than boomers not selling their home, instead wanting to age in place. And that just means they want to stay in their home and not go to a nursing home or assisted living. And that was recently quantified in a survey that HousingWire reported on. It found that 54% of baby boomers say that they'll never sell their homes, some of them passing homes along as inheritance. And see, often that's because their home is paid off and assisted living care costs are through the roof. More than half of boomers don't have any mortgage at all. All right, so we've established that boomers aren't as old as most people think, and then a lot of them aren't planning to sell. But still, let's look for trouble here because boomers are a huge group, and some portion of them are going to sell as they age, even if a lot of them say that they won't. How about the almost half of boomers with a mortgage? You know what? Here's the thing. If they downsized, like older people have traditionally done, I mean, my grandparents downsized long ago, but do you know what would happen if boomers downsized today? For most, their monthly mortgage payment would actually go up if they downsized. That's because of today's higher mortgage rates and home prices. And see, that's a financial reality that keeps them in place. They're never going to downsize. All right, so a lot of boomers are just not going to sell. But still, this wave of selling boomers crashing the housing market, this has been a popular narrative for, I don't know, maybe more than a decade now. There's been a lot of smoke, so then where is the fire? That's another way to think about this. So there's got to be more to this, and there is. In fact, people age 55 plus own more than half of the homes in the U.S. Did you know that? All right, well, if we pull back from boomers and let's just take a look at all homeowners of every age, people are staying in their homes longer, whether they're age 30 or 50 or 80. Americans now stay in the same home about 12 years. That is twice as long as 2005. Well, what that means is that homes don't come onto the market and people cannot buy what's not for sale. And then, of course, you've got the well-documented interest rate lock-in effect. That's a contributor here, too. People of all ages with 4% mortgages, they are reluctant to sell. And now what we're talking about here are demographics. Remember that quote, demography is destiny. The three-word quote from 1800s era French philosopher Auguste Comte. And that's because it's completely predictable. If you're 32 years old today, in 10 years, you'll be 42. Totally predictable. All right, if demographics could possibly crash housing prices, let's step back and see what's going on with overall U.S. population growth. You know what? It just grew at its fastest rate since 2001. About a full 1% growth last year. Yeah, we broke the 340 million population mark for the first time ever. And now, what about the portion that are immigrants? And what if a substantial amount of them get deported? I mean, after Trump settled into the White House for his second term, deportations began almost immediately. Is there enough population growth to buy from the boomers that do sell their homes? Well, if mortgage rates come down into the low fives, then maybe more boomers will sell and bring some more resale inventory onto the market. See, you need a good chunk, though, of buyers to come in from somewhere in order to support future housing prices. Well, where are those buyers going to be? Well, some people still don't realize that the largest generation in American history is, in fact, not baby boomers. It's millennials. They became the biggest group more than 5 years ago. In fact, Statista tells us that Gen Z isn't far behind them either. Yeah, Gen Z is almost as big as millennials as a group, coming right behind them. And of course, this varies a little bit. Demographers parse the generations somewhat differently. But here's what the rise of the biggest generation means. Millennials, they're aged 29 to 44 now, and there are over 70 million of them. And then almost as big, the next group right behind them, Gen Z, their ages 13 to 28, they alone number about 70 million themselves. Even if you just completely leave the surge in immigration out of the picture, and all the additional housing demand that immigration brings. So we're merely just looking at the domestic side alone here. What's happened is that there were 4 million plus births per year from 1990 to 2010, providing a tailwind for housing demand through 2035, 2045, or later. Yeah, we had more births during many of those years than we did in the peak of the baby boom, which was 1957. Like I've mentioned on the show before, the average age of a first-time homebuyer is now a record high of 38 years old per the NAR. It's really taken a long time for some people to stop playing the video games and moving out of their parents' basement, okay? Well, the peak birth year for the U.S. was 2007. I just told you it was elevated between 1990 and 2010, but 2007 was that peak. All right, so take that peak and add 38 years to it, and you know what? The first-time homebuyer demand is just going to continue to build, 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 and not even reach its peak then until 2045 or so, the peak birth year 2007 plus 38 years. That is where the crush of future demand is coming from, because that person born in 2007, on average, they're not even going to buy their first home until well into the 2040s. In fact, the number of Americans turning 35 every single year is high, and it just keeps increasing. It's over 4 million now, already up 25% since 2011. And this number of Americans turning 35 is going to keep rising for another decade or two. In fact, this year, it's going to approach 5 million Americans turning 35. New record territory coming. And I keep bringing this up because 35 is a key age, because by that time, almost everyone has moved out of their parents' home. And so that's the time where people either need to rent or own themselves, pushing up both rents and prices. And that's why this wave of demand and pent-up demand is just gonna keep coming. And by the way, those stats that I gave you there, they're all sourced from the U.S. Census Bureau. I mean, this is exactly where the housing demand just keeps coming from. It's a big factor about why prices keep going up. The demand just keeps piling on. Even though affordability worsened, the demand just keeps coming, and it's just going to keep on coming well into the 2040s. Now, it could very well ebb substantially by, say, the middle of the 2050s, but we'll see, and that is still 3 decades away. And remember, all of this doesn't even include the additional population growth from immigration and how many non-deportees that is going to add to the housing demand on top of this. And then if that's not enough, there is even more future housing demand expected to come from the declining number of occupants per household. Yes, the reduced household size, that stokes housing demand. I touched on this with you a little before on a prior show, but let me go deeper as we continue to corrode this more dyers than buyers theory. As we break this down, people have smaller families today. I think everybody knows that. Back in 1960, there were 3.3 occupants per household. Today, it's just 2.5. And to give you a simple example of how this itself keeps stoking the housing demand, just say that there's a village of 100 people. With 3 occupants per household, they would need 33 1/3 homes. Over time, when that drops to 2 occupants per household, that's the direction we're going. Now that same village needs 50 homes just in order to accommodate the shift in household structure. Well, 50 homes is 50% more than 33 1/3. Well, that means 50% more homes are needed. And that's even in a scenario where the population stays the same. Yet it's not staying the same. It's rising, and the population is really rising fast for that key household formation age range of 35 to 38 years old. Fewer Americans are living together. I expect the housing market to continue shifting toward smaller household counts. One-person households will keep rising. I expect that to be one of the most impactful housing trends of this entire 21st century. And it's also really helping fuel a loneliness epidemic, which is another subject unto itself. Well, the three main drivers of this rise in single-person households is that first, people are delaying those major life events compared to previous generations. They're attending school longer, they're marrying later, they're buying homes later, they're having children later. And as these events are postponed, the time some young adults spend living alone or without children increases. They're playing video games longer as well. The second driver of these single-person households is falling birth rates. When people have children, many are having fewer than previous generations, reducing the average household size. That's pretty obvious. And then third, the population composition is getting older, and older people tend to live with fewer people. If life expectancy rises, this component of the trend would only intensify. Yes, the whole Brian Johnson thing. He is the health influencer that says we now have alive the first generation that's going to live forever due to advances in longevity and technology. I mean, my gosh, if he is right, what would that do to housing demand? I mean, and it would also push up our average age even more. Gosh. Yet at the same time that all this demand keeps pushing up, America already has a well-publicized overall housing shortage of several million housing units. You already know that story well. Construction has picked up a little, but not enough to keep up with demand. In fact, American housing supply is still about 30% below pre-pandemic levels. So, suffice to say, let me give you a satisfying, definitive answer here. When are selling boomers going to crash housing prices? It is highly unlikely that that can even happen at all. In fact, you see fewer stories about this than you used to. More people have come to realize that it is just not happening. And looking at U.S. demographics over the next few cycles, a lot more people will need homes. Demand continuing to exceed supply. This is why home prices should just keep rising from here. In fact, I have been an active single-family rental property investor here myself. Single-family is where perhaps the greatest shortage is and the greatest demand is at the same time. I am owning something that people are definitely going to need more of. Remember, demography is destiny, and they're going to pay more and more for it. When mortgage rates fall, it's probably going to bring in even more buying activity. And now, all of this continued upward, long-term, future price momentum for housing, of course, that all existed before Donald John Trump stepped into the White House to start his second term last month. I think the Trump factor, or Trump bump, it often gets somewhat exaggerated for what it can do to the economy and housing prices, right? I mean, I've talked to you before. It's about the decisions that you make more so than decisions that a politician makes. But Trump is doing some things on a pretty seismic level. These nascent immigrant deportations, that obviously can increase the cost of labor. You're exporting away your low-cost labor with immigrant deportations. I mean, that is inflation. Tariffs, though some tariffs have been negotiated away for the time being, that's more inflation. So deportations mean wage increases, That's more inflation. Increased wages mean increased rents. Trump talks lower taxes. Lower taxes can then mean higher rent payments. Proposals to eliminate taxes on tips, overtime, and Social Security. That means that Americans and retirees are going to have more disposable income. More income means higher rent collections, fewer delinquencies, and potentially rising home prices as affordability improves. That's a lot of the good news. It's not all rosy news. You better look out for high tax states, SALT adjustments, that's state and local income tax, and a deduction cap could harm their property values. I'm talking about places like California, New York, and New Jersey. The 2017 Trump Tax Cuts and Jobs Act, that gave real estate investors some really juicy benefits, like 20% pass-through deduction for LLCs and bonus depreciation on rental properties, and lower corporate tax rates too. Combined, this stuff, it all keeps more money in your pocket and allows for bigger deals with better cash flow. We're talking about Trump bump factors on the real estate market here. Other proposals on the table, there are things like tax breaks for domestic production. That could boost U.S. construction, leading to more badly needed housing supply. That could lower building costs and investment opportunities in niche and growth markets. Remember opportunity zones? And then what about targeting wealthy investors? We'll see what happens, but Trump's plan removes tax breaks for hedge funds and billionaire sports owners. But could real estate investors get hurt a little on that side too? Maybe. Look for changes to the 1031 or depreciation strategies. But the 1031 exchange has been around for over 100 years. I would be surprised if it went away completely. And yes, though they have been postponed, if 25% tariffs on Mexico and Canada do go into place, and the countries retaliate as they've been shown to do, it would add 0.76% to U.S. inflation and subtract 0.4% from U.S. GDP growth. Aren't those two projections interesting? Yeah, those estimates were compiled by the Yale Budget Lab. So adding about 0.75 percentage point to the overall inflation rate with these tariffs. I mean, everything. We're talking about the price of your housing or your car tires or your tomatoes and romaine lettuce. I mean, that effect could take money out of people's pockets. Yes, we know that Trump wants to bring down interest rates, but I don't know how he's going to do that. I mean, as you know, more inflation correlates with higher rates, not lower ones. See, you just can't get it all. You just can't have it all. And of course, mortgage rates are not historically high. They've simply been normalized. After years of being artificially low, rates are normal. So normalized is really a term that I like to use. So really, to help summarize what I've shared with you here in the first half of the show, a housing price crash induced by a boomer sell-off is not a thing. In fact, almost oppositely, demographics and this pent-up demand should raise up future home prices, and to a lesser extent, a Trump bump can as well. Yes, gosh, Trump just has an insatiable fascination for tariffs. It is truly amazing, and it has more stick-to-itiveness than, say, Mark Zuckerberg's recent fascination with masculine energy and gold chains. That's for sure. Hey, before we get into the pernicious vice that's destroying more people's lives today, especially young men, and almost no one is talking about this. It's leading to lower credit scores, more bankruptcies, and even more suicides. First, I've got some cool things to tell you about. 2 weeks ago here on the show, event host Robert Helms of the Real Estate Guys and I invited you to join us on the terrific Investor Summit at Sea, that cruise on the Caribbean. Besides the two of us, there are a number of other great faculty members. Robert Kiyosaki recently announced that he's going to be joining us on the faculty as well, so you'll get to meet and learn from Robert Kiyosaki. And if you happen to be a new listener, he is the top-selling personal finance author of all time, the Rich Dad Poor Dad author, and he's been our guest here on the GRE podcast 4 times now. I hope to meet you, the listener, in person on the Summit at Sea in the Caribbean this June, starting out of Miami. Gosh, what an outstanding time that is. It's not a low-cost event, however. The minimum cabin, an interior cabin, is $5,900, and they are more expensive from there if you get nicer accommodations. But all the details are there on GRE Podcast episode 539. 2 weeks ago. I really hope you'll join us and that I can meet you in person. Earlier this month, Trump established a U.S. sovereign wealth fund, and when he did, I congratulated our frequent contributor here, macroeconomist Richard Duncan, because Richard championed the establishment of that fund for years. He presented to Congress about it, and Richard was the first ever GRE guest with us back here in 2014. On the Panama coffee farm investing that we've discussed here on the show, Villanova University reached out to them, and they're now collaborating together. It's something I find kind of cool as a Pennsylvania native, and one of my tightest best friends is also a Villanova alum. As for future episodes coming up on the show here, imagine if you had a property loan, yet you didn't have to make any payments. And if you did make payments on your loan, then every penny of that payment goes to principal, not to interest. Wouldn't that be incredible? Well, such a thing does exist, and it's not new or experimental or avant-garde. People just don't know about this vehicle. We're going to discuss that right here on next week's show, along with some other vital mortgage topics. There are 3 ways to connect with our education at GRE. You're listening to one of them right now, our flagship podcast. Also, check out our Get Rich Education YouTube channel because that is different content than this show. That's the second way. And that show is also on other video-first platforms like Get Rich Education on Rumble. And finally, you'll have it all 3, when you get our weekly Don't Quit Your Daydream newsletter. If you don't already, get it free now while it's on your mind. Simply text GRE to 66866. More next. I'm Keith Weinhold. You're listening to Get Rich Education. Hey, you can get your mortgage loans at the same place where I get mine at Ridge Lending Group, NMLS 42056. They've provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com. Oh, geez. The national average bank account pays less than 1% on your savings, so your bank is getting rich off of you. You've got to earn way more, or else you're losing your hard-earned cash to inflation. Let the Liquidity Fund help you put your money to work with minimum risk. Your cash generates up to a 10% return and compounds year in and year out instead of earning less than 1% in your bank account. The minimum investment is just $25K. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And you know how I know? Because I'm an investor in this myself. Earn 10% like me and GRE listeners are. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. Every once in a while, there's an investing adjacent activity that becomes pronounced or becomes such a trend that it just can't be ignored, and you need to know about it. I recently presented on how gambling is financially derailing so many people today, especially young men and sports gambling. And what makes California and Texas special here, the two most populous states, by the way, you'll see. Once they legalize this, it's going to get worse. They're two states where it's not legal yet. Now, investing in gambling, they are two distinctly different activities. Investing is different from gambling. When you invest, you're purchasing a stake in an asset that has value in an effort to generate profit. But gambling doesn't involve taking ownership of anything of value. Instead, bettors are predicting the outcome of an event. Gambling, it's really not a side hustle. I mean, people are constantly losing their families and businesses over this. This will be all new material here on the show, as usual, except for a short snippet that includes Super CPA Tom Wheelwright. This is about 10 minutes in length. Shout out to the media team here at GRE on the production side. And then after this, I have more to tell you about real estate.
America is in the midst of an historic surge in legalized gambling.
And that's a cover. And that's $10,500.
This is the worst thing that people are now doing with their time and money today. It's not losing it to inflation. It's not playing video games. It's being a slack-jawed gambling degenerate. We are in the midst of an historic surge in legalized gambling, and the devastation on gamblers, especially young men, is a lot worse than you think. I've also got a giant, ominous warning for you that seasoned gamblers don't even know about when I bring in my CPA for just a minute here today on the seriously punishing tax implications that should scare anybody out of gambling. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, best-selling author, and longtime real estate investor. Almost 60% of 18 to 24-year-olds have placed at least one sports bet now. That's per the NCAA, and that has surged so fast. I mean, just less than a decade ago, major pro sports leagues shunned gambling, disassociating with it because it was illegal in most places. The big turning point was 2018. That's when the Supreme Court ended a decades-long ban on commercialized sports betting. 38 states in D.C. have now legalized it, most with minimum age requirements set at 21. And the two biggest platforms are DraftKings and FanDuel. They've got about 70% of the market. But look, you can do this if you're under 21 on platforms like Prize Picks and Fliff. They offer betting-like experiences. They operate under fantasy sports or sweepstakes. And having these apps on your phone, that just brings the gambling right to you. It keeps it in your face and addictive. Now it's like you're sitting in a casino when you're on your living room sofa or in your bed or even in the bathroom. There is no escape. 2/3 of Americans live in a state where they can access it on their phones. And look how young some of these gamblers are, what they have to say, and then who's showing up in these Gamblers Anonymous meetings.
In today's world, it's the 16, 17, 18-year-olds, 19, 21-year-olds that get addicted. Years ago, before online casinos, if we had a person coming in under 24 years old, it was rare, all right? Now the norm, the real norm, it's kids coming in at 17 years old. That's the norm.
Well, one big reason why it's such a problem is, look, you can't hide it so that therefore others can't tell if you're gambling because you're not, shooting it into your veins, or you're not acting drunk, or you're not smoking anything. See, you can gamble without exhibiting a physical change. So therefore, others don't know that you need help. And it is all over the place. I mean, gambling ads air on TV over 60,000 times a year. Celebrities endorse gambling. I mean, some teams put gambling ads right on the field. Brick and mortar sports books are even built inside some stadiums now. Caesars and BetMGM, there are two other big platforms that you might see out there. But I mean, in their commercials, they can put that 1-800-GAMBLER help number on screen and tell you things like gamble within your limits. But look, here's the thing. These platforms, they're not going to cut you off if you continue to lose and they profit. In fact, if you win disproportionately big time after time, and these platforms can kind of tell that you're too smart, you know what they do? Like a casino that identifies a card shark in Vegas, they're either going to curtail your activity or just totally cut you off. All right, so then by definition, if you have an account in good standing at FanDuel or DraftKings and you bet a lot and they keep letting you play, well then you have just signaled to the entire world that you don't know what you're doing and you are going to lose big, or you already have. I mean, that is baked into the cake. That's how the system works. So therefore, these companies are basically mining America to find anyone stupid enough to keep placing these sports bets. Companies are profiting from this, and then states are too. I mean, they've collected billions in tax revenue, and FanDuel and DraftKings, see, they're publicly traded companies. So this means that they have shareholders, and those shareholders, they want to see profit and growth. I recently asked decorated CPA and mega popular tax author Tom Wheelwright about tax rates on gambling for just a quick 3 minutes here. I mean, you won't believe how punishing this is. Can you tell us about sports gambling taxes and how it's treated?
So remember, all income is taxable. So that includes gambling winnings. They are taxable. In fact, you'll get a 1099, just like you would if you rendered services, you'd get a 1099, right? Or you have interest income, you get a 1099. You get a 1099 from gambling. What you actually have to show is that you actually have gambling losses. So you have to track those gambling losses to show the IRS that you've got gambling losses, but your gambling losses can never be more than your gambling winnings. In other words, you never get to generate a tax loss on gambling. So that means is that if you win $10,000 during the year and you can prove that you lost $8,000 during the year, you're going to be taxed on $2,000. But if you can't prove the $8,000, you're going to be taxed on $10,000.
Yeah, so you, the gambler, have the burden of tracking this, and I guess tracking your losses. I'm not a gambler. How would one track their losses?
Oh, I would keep detailed ledger. Personally, I'd probably have a separate bank account just for gambling.
Gosh.
That's the way I would do it. I'm not a gambler either. So, by the way, it's also a good way to budget your gambling so that you don't get in trouble, right? So just set up a separate bank account, put whatever money you say, I'm comfortable with this money, I'm going to gamble with this money, put in that bank account, and then you have a ledger that shows the money that went in and the money you lost, the money you won. And don't do anything but gambling in that bank account.
Hey, that separate account's a great way to hide it from your spouse. Not that I'm suggesting that. Well,
all right. Interesting you went there.
I'm not a gambler at all. Can't even believe I was thinking that far ahead. What are the gambling tax rates like?
They're ordinary income tax rates. So gambling winnings are just ordinary income. They're the same as your wages. They don't have Social Security taxes. Their income just like any other kind of income. Nothing special.
Okay. And this all applies to whether it's sports gambling or general gambling, like lotteries and sweepstakes?
Just remember, all income's taxable unless the government says it isn't. All income. Okay. And then there's some types of income that are taxed at special rates, like capital gains. But gambling has no special rate, so it's just your ordinary income rates.
Gosh, to me, it seems like it's hard to break even with gambling over time. And then when you take the tax adjusted earnings that you get from it, over the long term, I just don't think, Harrah's and Bally's Casino is really incentivized to inform gamblers on how punitive this can be with ordinary income tax rates applied to gambling winnings.
No, but they will send you 1099-G, I guarantee that.
So can you imagine tracking all that and then paying all that in tax? And this is even if you're on the winning side, and then keeping a separate bank account as well. And note that Tom and I were talking federal there. It gets even worse. Some state laws are punishing, like New York, which has a 51% tax rate on mobile sports wagering. Bankruptcies are up 28% since states have legalized this, and credit scores have dropped. Now, California and Texas are the two big states, and they still haven't legalized sports gambling. They're the two big ones. And when they do, that's when you'll see more bankruptcy and more people, especially young men, in financial ruin. I mean, Gamblers Anonymous meetings are filled with people hooked on betting and on stock options trading too. And, worse still, among addiction disorders, gambling has a comparatively high suicide attempt rate. And, understand that while both involve risk, investing and gambling are two different things. When you invest, you're purchasing a stake in an asset that has value in an effort to generate profit. But gambling doesn't involve taking ownership of anything with value. Instead, bettors are predicting the outcome of an event. Now, I gambled as a teen on sports, and back then it was just a friend and I. We would each lay a $20 bill on top of the television at the start of like a Mets versus Phillies baseball game, and then it sure made the game more interesting to watch. There wasn't any sort of app to make it easy, suck me in, and make it a recurrent practice. I haven't gambled since. Now that you're aware of the gravity of the problem, the best thing you can do for yourself is to delete those apps off your phone. Because look, every gambler that had their lives flipped over and turned catastrophic, at one time they told themselves, I'm doing this, but it's under control. Everybody once said that. The best thing you can do is delete FanDuel, DraftKings, and any other apps like that off of your phone right now and vow to never do it again.
I hope you like that. It's sort of interesting and introspective to me that I would produce a piece of media like this because I am a sports fan. I watched more of the NFL this past season than I have in a while. I'm in a phase of my life where I'm a pretty productive person doing research and interviewing guests and producing GRE media. But, I justified watching more sports lately because there's room for an entertainment bucket in everyone's life. That's how I feel. And, I don't really watch movies. Most movies I watch feel like a waste of my time when I'm done after 2 hours because I'm usually disappointed in it. If I ever watch movies, I gotta watch movies on the plane because even if it was lousy, I got somewhere in the process. So in any case, now if gambling is controlled, well, then it might be debatable about whether or not it's a vice. Like say you go to Vegas and have your $250 spending limit or whatever. But just remember, every gambling degenerate once told themselves and everybody that they know that they've got it under control. But yeah, often they didn't. Around here, we champion owning real estate directly yourself. That is something that is in your control. So we're not talking about REITs, real estate investment trusts. That's just a publicly owned company and a group of them. It's not real estate tokenization. That means owning digital fractional shares of a property or a real estate investment. Direct whole ownership also means it's not a syndication. Now, that might be worth doing, though. That means that you're pooling other investors' money. It's not direct whole investing if you are investing in someone else's syndication, meaning that you're a limited partner. And direct real estate investing, it means not being a flipper or a wholesaler. Again, those things might be worth doing, but they're really time-consuming and they're not tax-advantaged either. But when you own rental real estate directly yourself, You don't even need to be a landlord if you choose not to. You then will not be that point of contact for your tenants when others manage it. And yes, because of the 5 ways you're paid, you can make the case that real estate has hegemony over other assets. And for the demographic reasons and the inflationary reasons, like the ones that I told you about earlier today, real estate appears poised to continue as the hegemon. In fact, recently, so many global hedge funds have dumped every stock that they have except for the real estate stocks. I shared that article with you in our newsletter recently. That's largely a tariff response. Let me tell you about real properties on GRE Marketplace right now that are ripe for owning directly. I mean, direct ownership, that's also the easiest to understand. You are paid rent by a tenant that lives there, often through your property manager. And unlike the out-of-control sports gambler, this is very much in your control. A brand new build single-family rental in Columbiana, Alabama, that's just south of Birmingham. Rent is $1,925. The price is $269,900. Over 1,600 square feet, 4-bed, 2-bath. Now, with the new build, expect low maintenance costs. It's currently vacant. Get an interest rate of 6.75% with a 25% down payment on this new build single family rental in Alabama. Then another sample here. This is interesting. The rent on this old build Davenport, Iowa duplex is $1,900, which is about the same rent as the Alabama single-family rental I just described, but yet the price for this Davenport duplex is just $183,000. Davenport is part of America's Quad Cities with a combined population of about 500,000. With both duplex sides, it's a combined square footage of almost 2,700 square feet, 5-bed, 2-bath. They're on Brown Street in Davenport. And now, as favorable as those $1,900 combined duplex rents are, since this property is vintage, in fact, it's over 100 years old, you better check closely on the renovations that were made to the property and have plenty set aside for any maintenance and repairs as well. With a 25% down payment, expect an interest rate of just 6.25%. And there are more financing details there. And of course, rates are always changing. The last one I'll mention is this new build, another duplex, this one in Inverness, Florida. This is really interesting too. And now, what do you think when you think of Florida real estate? Does climate change come to mind? For some people it does, for some it doesn't. Maybe even rising sea levels over the long term. Well, Inverness, Florida is 15 to 20 miles inland, and it's 50 feet above sea level. How about high insurance rates? Does that come to mind with Florida? Well, they're not so high on new build properties since they're built to today's stringent hurricane standards. Is Florida temporarily overbuilt, even though the nation in aggregate is underbuilt? Yes, some Florida markets are overbuilt, and that's how you could potentially snag a deal. And get this, with 25% down, you can get an interest rate as low as 4.75%. Yes, and that's showing with 0 buyer-paid discount points. The combined rent from both sides of this new build Inverness duplex is estimated at $2,830. Of course, often you need to estimate a rent range or make an estimate on the projected rent for new builds because often they're not occupied yet since they were just built. Sales price of just a touch under $420K on the Inverness duplex. And as just one of the 5 ways you're paid, the cash-on-cash return is projected at 5%. Yes, your return goes up into the positive cash flow zone when your mortgage rate is as low as 4.75%. I mean, that is really
attractive. It also comes with a year of free property management. So there you go, a new build single family rental in Alabama, an old duplex in Davenport, Iowa, and a new build duplex with just killer incentives in Inverness, Florida. And that's just a sampling of Real Estate Pays 5 Ways type of properties. We either help you get started or continue on your path to financial freedom and help you do that with our completely free investment coaching. We work with you to help you with these properties or others like them, or none at all if it's not in your best interest to invest now at gremarketplace.com. All you need to do to get started from gremarketplace.com is click on the coaching area and you can get on the calendar for a free strategy session. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.